Hey guys, welcome back to the channel. My name is Timothy, and on this channel we speak everything personal finance. And in today's video, we're going to be talking about the financial order of operations. Now, this is not something that I created. This was something that was created by The Money Guys, a finance YouTube channel that talks about all kind of things finance, from mortgages, from paying off debt, from investing, from how to invest. This is their preferred order of operations of when it comes to finances. So if you ever heard of the baby steps from Dave Ramsey, it's similar to that, but this is their baby steps, which is a little bit different than Dave Ramsey's, a little bit more in depth, and I love it, and it is something that I go by to this day. So if you're excited for this video, be sure to leave a like and subscribe to this channel, and let's dive right in. The first step being deductibles covered. So you want to have your insurance deductibles covered for when bad things happen in your life. When you have hospital trips or hospital bills that need to be paid, you have these deductibles covered. So if you have to pay out of pocket, you're able to pay that. So having your deductibles covered can keep your financial life out of a ditch. Say you have a trip to the emergency room, you have to pay that out of pocket. So then you have your money that you set aside for deductible, and you're able to pay that instead of going to credit card debt. So you likely have deductibles on health insurance, car insurance, and homeowner insurance. At least have your deductibles covered before we go to these next steps. For Dave Ramsey's step, this is similar to having the first 1,000 saved, but a lot of times 1,000 is not going to do much for you. But by saving $1,000, you're kind of getting into the habit of saving. But with the deductibles covered, it's a little more in depth. So if accidents happen and they just happen out of nowhere, you're able to cover that. And you may be wondering if you have to save for all deductibles. For step one, you want to save for the highest insurance deductible. So say your deductible for healthcare is $4,000, your deductible for car insurance is $2,000. So you want to save that $4,000 first, since that's your highest deductible. The biggest risk is a single emergency. While you might have multiple emergencies, we'll get to where you save for your emergency fund on step 4. And if you don't know how to find your deductible, you can always just call your insurance companies and ask them what your deductible is. And if you don't have a deductible, that means your policy covers a lot of things from the start, which means you might have a higher insurance premium. We'll just move on to the next step. And step number 2 of the financial order of operations is to get your employer match. So this is free money that you don't want to leave on the table. So this comes before paying off credit card debt, because yes, credit card debts may be at 20% to 15%, but an employer match is 50 to 100% of your money. So that's a bigger return. So we want to get free money or almost free money before we pay off credit card debt. So if your employer is saying put 4% and we'll match you when you put 4% into your retirement account, do that. It is free money. They're going to be matching you 4%, which comes out to 8% that is automatically invested into your retirement. And what if you don't have an employer match? Just move to the next step. You don't have an employer match, then we're going to be going to step 3, which is pay off credit card debt. But before we go to step 3, I want to show you why it's important to put money into your employer match and how much you'll get compared to having an employer match and to not having an employer match. So suppose you make $50,000 a year and your employer matches you at 5%. So if you contribute $2,500 annually, then your employer will then contribute $2,500 annually. So over 30 years with the average annual return of about 7%, you would have over $566,000. Without the match, you would have about $283,000. This is different than Dave Ramsey because his second baby step is to pay off debt. Pay off credit cards, student loans, auto loans. And yes, it's for a short period of time, but we just don't want to miss this employer match because 20% for credit card debt is a lot lower than the 100% that you've been getting or the 50% that you'll be getting from your employer match. And for baby step number 3, we're talking about paying off high interest debt. So high interest debt can be incredibly harmful, which is why it's highly prioritized in the financial order of operations. So paying off this high interest debt will help you invest more into your retirement. And one reason you want to pay off this high interest debt is because you're going to be losing money if you're investing into the market. So say you get an average return about 7 to 10% by investing into the S&P 500, but then the average credit card interest rate might be at 15 to 20%. You're losing money because the interest rate is higher on the credit card side than it is on the investing. You might be thinking, does mortgage count as a high interest debt? We're not counting the mortgage as a high interest debt. Typically mortgages have a lower interest rate, but yes, interest rates are around 76%, but it's also an appreciating asset. So just kind of paying that off regular is fine. Plus you could take multiple years to pay the mortgage rates off, and we want to start investing money as soon as we can. And step 4 is building an emergency fund. An emergency fund is vital to staying on track financially and paying for unexpected expenses, so we're not relying on credit cards. And going back to step number 2. And guess what? Your deductible saved becomes part of your emergency fund. And to find out your emergency fund, you basically just calculate your expenses for the month and you multiply that by 3, which is 3 months, and 6, which is 6 months. And comment in the section below which step you're at right now. Are you at step 1 or are you just step 4? And we have a few more steps to go. And step 5 is to maximize your Roth or HSA. The Roth and HSA are powerful tax-free retirement accounts. And why is the Roth so powerful? Well, it's because the money you put in is post-tax money, and then when you pull that money out, it's also not taxed. And the maximum that you can put in for 2024 is $7,000 if you're under 50 and $8,000 if you're over 50. So if the government is really putting a limit on how much you can invest into your Roth, that just kind of shows how powerful it is. And step 6 is to max out your employer plan. Step 6 is not easy to max out these retirement plans. We're talking your 401ks, your 457s, your 403bs. You have to have a pretty good income to max out the retirement account. But if you're able to do it, do it. It benefits you greatly, especially when you reach retirement age. And step 7 is hyperaccumulation, but basically it's investing 25% of your income. This might be through employer sponsored accounts like your 401k. This might be through your Roth IRA, or it could be through a brokerage account. But if you're investing 25% or more of your income, then you're in step number 6. And when you reach step 8, that means you're really hammering on everything. You kind of have everything lined up. Retirement's already taken care of because you're doing that 25%. Now in step 8, we're talking about prepaying future expenses. And this could be your 529 plan for your children or other accounts, depending on your path. Of course, my path, we're paying for the 529 plan right now because we are at step number 8. We're already investing 25% or more of our income, so we're now prepaying our kids' college in our 529 plan, and we're also saving for different things like real estate, and we're also investing into real estate. And this is kind of that step where you begin looking to invest into real estate, because all these different kind of investments and kind of risk things aren't always guaranteed to give you a good return. You want to hammer the basic things out like your Roth and your 401ks and make sure those are good before you start taking risks like investing into real estate or invest into some kind of business that you want to start. And then for the final step, we're talking about paying off low interest debt. Now, this is where you start paying off student loans. This is where you start paying off your house, because student loans are between 4 to 5%. So if you're making 7% from the markets or 10% from the markets, you're making more money from investing than you are paying off your student debt. By following the financial order of operations, you can reach financial peace and stability. Now, this is not something I created. Like I said, this is something that was created by the Money Guys. So definitely check them out. And honestly, if you have no financial base, these are great steps that you can follow to kind of get your life in order. So I hope you guys enjoyed this video, and if you did, please leave a like and subscribe to my channel, and I will see you guys in the next video.